Hello again, I'm Mike Brown. Welcome back to another video. And in this one, we're going to be talking specifically about bad debt expense as it relates to accounts receivable. So ultimately, what is going into bad debt expense? Well, generally speaking, it's a provision that is made throughout the period. So a company may decide, look, at the end of the year, we're going to base it on the allowance, or maybe the end of the quarter for that matter. The allowance is going to be based on the accounts receivable balance. But they say, you know what, during the year, we're just going to go ahead and record 3% of sales, just to keep the balance up to date as best we can, and then we'll kind of correct or true it up at period end or year end or quarter end. So it's usually made up of a provision each period, and then an adjustment at year end if it's needed. So that's how bad debts will run. But that's not the only thing that's going to go on. Now, it's not going to affect bad debt expense, right? That's basically it for bad debt expense itself. But then we have to deal with, well, how do they write off a bad apple? How do they write off that bad receivable? So the write-off simply means, oh, we're going to assign the allowance. So the allowance, which is originally created by a credit, right? It's debit bad debt expense, credit the allowance for doubtful accounts. We're now going to debit the allowance to remove it, and we're going to get rid of a matching receivable. So we're going to debit the allowance for doubtful accounts, and we're going to credit accounts receivable for the same amount. Now, the benefit of doing it this way is, okay, that's what we were taking the allowance for. Good, we get it out of there. But now the allowance is going to be reduced. So at the end of the period, if we still have a significant or maybe the same basic number in accounts receivable, great, we're going to have to record some additional bad debt expense. And that makes sense, right? We're going to say, oh, well now, yep, we had one that went down to a write-off, but looks like we've got a bunch of new AR that have taken its place, and we're going to need to make an allowance for them going forward. All right, so let's play back the timeline. There are sales that create receivables. When that happens, we're also going to make an allowance for some of those receivables to not be collected. And ultimately, we're going to identify a specific receivable where we're going to write it off. But there's one more possibility. What if we write it off and then they pay us anyway? So we have a subsequent collection of a previously written off receivable. Well, let's touch briefly on the direct write-off method. Remember, that's not GAAP, but the IRS, that's how they would deal with it. Well, they would say, well, when you wrote it off, you got to take that as a deduction. That was bad debt expense. So when you collect something, it's collection, it's income. So that's how you have to treat it. So it would be a debit to cash and a credit to some kind of an account, call it uncollectible accounts recovered, that effectively recognizes that unexpected income. But let's deal with GAAP. Let's talk about the allowance method. I love how symmetrical this is. I know, that's me. I'm weird. But here's what they do. They say, oh, well, you remember when we decided that was the bad apple? We were wrong. So why don't we just hit the undo button? So we're going to reverse when we identified a bad debt. We're going to put the AR back, and we're going to put the allowance back. In effect saying, oh, we assigned it to the wrong one. Oops. And once we reverse that entry, now it's just a normal collection again because the accounts receivables back on the books, and so we simply debit cash and credit accounts receivable. Now, if you merge those two together, you see the net effect is, oh, basically the cash I collect goes back into the allowance. And that's effectively correct. But I like showing it as a two-step entry because it really encompasses this idea of, okay, we undo what we did because we were wrong. And now we're going to collect that receivable that's been put back on the books. Okay, why don't we do an example of a bad debt expense calculation. So we have Bost Company. So Bost is making a change. They actually are going to aging accounts receivable. Previously, they had used the percentage of sales approach, which was one method that was used. And as I say, some companies may still use that as a figuring their provision month by month, and then they would use a percentage of AR or a percentage of the aging approach to true that up when they issue a report. And I'm going to set up my base mnemonic here. And again, base is beginning balance plus any additions minus any subtractions equals the ending balance. And the reason I want to do that right out of the gate is because I'm looking at this going, oh, there's a lot of numbers here. I need a way to keep it organized. So I'm going to do this based on the allowance account. All right, so let's read line by line. First, the allowance for uncollectible accounts at the beginning of year 5 was $20,000. So I'm going to mark that with a B, and I'm going to put $20,000 in as the B, the beginning balance. All right, what's next? It says, well, here's the provision recorded during year 5. So that's what they've been doing. They said, yep, during the year, whenever we had a sale, we recorded bad debt expense of 2%. So it turns out they've already put $14,000 more into that account. I'm going to mark that with an A. So I'm going to put that as an addition, $14,000. Next, it says, well, in November, we wrote off bad debts to the tune of $12,500. Okay, so that would be an S. I'm going to mark that with an S. That's a subtraction, so that would reduce the allowance by $12,500. And then finally, it says, oh, what's the estimated total of uncollectible accounts at the end of the year? It says, well, it's $20,500. So that's using the new percentage of receivables method that they've decided to employ. I'm going to flag that with an E. That's my E. So as it stands, I've got $20,000 plus $14,000 minus $12,500 equals $20,500. Only one small problem. That doesn't add up right. We're missing something. Time to figure out, what are we missing? What is the missing piece? What does it represent? Well, let's do the math first. What are we missing? Well, let's see. 20,000 plus 14,000 is 34. Minus 12, that's 22, minus 500. So we're sitting at 21,500. We need to be at 20,500. We're 1,000 shy. So I know I need one more S to the tune of $1,000. What is that? That's the plug to bad debt expense. That's the year-end adjustment to bad debt expense and the allowance. Now, notice what the requirements are. So first it says, calculate bad debt expense for the year. So what is total bad debt expense? Well, remember, we recorded it during the year, and we have a year-end adjustment. So the net bad debt expense is $14,000 minus the 1 we just adjusted for. It's $13,000. That's bad debt expense. Second, it said, well, we figured out the write-offs. We didn't record that entry. What does that look like? Well, they told us that the write-off was $12,500. And remember, we deal with write-offs by debiting the allowance and crediting the receivable for $12,500. Finally, it says, how do you record that $1,000 adjustment at period end? It's going to look a little funky because we're reducing the allowance, so it's actually going to be a debit to the allowance for doubtful accounts and a credit because we need to reduce bad debt expense for the year by $1,000. So that responds to each of them. All right, I hope that was helpful to give you some more insight into bad debt expense.